Hello and happy October. Welcome to another webinar Wednesday. Feel free to start some chatter in the chat. I'm here in San Francisco. Where's everybody else calling from? Welcome, Bradford. Welcome, Marilyn, Jam, Kathy. Welcome, welcome. I think we've got a small group today, so feel free to utilize the chat, the Q&A feature. We're going to talk about, well, every Wednesday is real fun because we talk about taxes every Wednesday. Plano, Texas. Got a lot of Texas this morning. Good afternoon. Who in here is a fan of spooky season? Because I definitely am. And I am so ready for the cool weather. Halloween movies in the background. Totally ready for it. Katie, it's your birthday month. I love it. I am a November birthday, so this time of the year is the best. Well, welcome. I think we're going to have a small group today. We've got 30 people here. Today, we're talking about what happens if you miss an extended filing deadline. So any questions related to this subject or LLC, S Corp, there are no bad questions on these sessions. We do ask that you use the Q&A feature just so that we don't miss questions at the end. So what we're going to do, we're going to take 10 minutes to get through a couple slides. Then we'll open it up for Q&A. So no bad questions. Please use the Q&A feature. And we're going to dive in. Thanks for joining. We're going to talk about what extended deadlines really mean, what happens if you miss the deadlines, and then what to do if you do have to file late. We're human. Sometimes things happen, intentional or not. There's always a solution. Sometimes they can be costly. And then we're going to open it up to live Q&A. So highly encourage participation, especially with a small group here. And we're going to dive in. I'm going to leave this up for a quick second. This webinar is for educational purposes only. Nothing contained in this presentation should be construed as legal or tax advice. Always consider consulting a professional if you need legal or tax advice in operating your freelance business. Okay, what do extended tax deadlines really mean? We've passed one of them. September 15th has gone away. If you have an S Corp or a partnership business pass-through tax return, that return would have been due September 15th. And then we've got an upcoming deadline, October 15th, if you filed an extension for your 2024 individual return. So what are these extended deadlines? Everybody knows the April 15th tax deadline. It's tax day for all of us here on the call. We're all US taxpayers if we earn taxable income. So this April 15th deadline is inevitable. If you file for an S Corp or a partnership, a business tax return, March 15th is another deadline on your calendar. Either of those deadlines, you can file for an extension on or before those dates, March 15th or April 15th. And the IRS and most states will grant you a 6-month extension to file, more time to file, not pay, your business and personal tax returns. So this extended 6 months, if you are on vacation when it's April 15th, if you haven't cleaned up your books, the IRS does give you more time to finalize the details of your tax return. And that's what we're up against right now at this time of the year. In the accounting world, we call it extension season. It's an extension of busy season. So if you've got a CPA or accountants, they just need a pat on the back because they're going through it right now. So extended deadlines. This is the final chance to submit returns that had an extension properly filed. So if you didn't file an extension, still obviously file your tax return as soon as possible, but filing the extension proactively will reduce the risk of underpayment penalties or late filing penalties. So you do have to be proactive in pursuing an extension. What happens if you miss an extended deadline? So if you have an S Corp tax return, it would have been due last month, September 15th. If you missed that, we're going to cover what's at risk and what steps you can take to resolve. So the real cost of filing after an extended deadline. I'm just going to put an asterisk that these penalties and fees most often, particularly at the individual level, most often only apply if you have tax still due. So if you filed an extension and you made an extension payment and you're comfortable that you're paid in beyond what you're going to owe, you still want to file as soon as possible, but you may not have a risk of, additional fees being assessed. So what's the real cost of filing after the extended deadlines? The IRS and your state, if there's a state level income tax, may start to add penalties and interest in different forms up until you finalize and file that tax return and pay any unpaid tax. So I'm not going to walk through this entire chart, but basically what it's doing is it's sectioning out the penalty, the different types of penalties and interest assessed on either your personal tax return. This is the one that's due October 15th. And then penalties for filing a late S Corp tax return. Now, I will clarify, an S Corp doesn't pay federal tax. So the penalties associated with a pass-through business are more often related to not providing K-1s to the owners. And so the fees for the S Corp are based on essentially not providing information to the ultimate taxpayer. On the individual side, the fees or penalties are related to unpaid tax if there's an unpaid tax balance due. So high level individuals, you'll usually face percentage-based penalties based on unpaid tax. S Corps will have like flat dollar amount fees assessed per shareholder if the K-1 has not been provided to the ultimate taxpayer. And I'm gonna check the chat. I'm gonna check the Q&A. No questions yet, which means this is making sense, hopefully. If you've got questions related to these extended deadlines or not, you're welcome to put them in the Q&A. Okay, so what happens if you miss the deadline? This could be some of you if you've got an S Corp tax return, partnership tax return that has not been filed yet. What are your options? The best advice, file as soon as possible. So that's the number one goal. If this means, getting your books cleaned up or making sure all your payroll is compliant so you can populate a business tax return, maybe it's, nudging a CPA so you get a K-1 so you can complete your individual return. Best advice is file as soon as possible. It's going to stop late filing penalties from being accrued if you owe. The second best piece of advice is just pay whatever you can. If you owe a large amount and you can only pay some of it, paying down what's due as soon as possible is going to reduce the baseline that your penalties and interest are accrued on. So file as soon as possible and just pay what you can. The best two pieces of advice that you could do up front. In the instance that you have a large balance due and you can't pay it, up front, the IRS does allow installment agreements. So this is essentially a payment plan that separates your payments monthly instead of owing a lump sum at the end. Generally, if you owe less than $50,000, the IRS will accept it. It doesn't stop penalties and interest from being accrued. So you still want to make sure you're following this payroll cadence. Maybe you can pay more than the installment payment or installment agreement lays out, but it does give you some grace with the IRS to pay over time instead of all at once. You may also be able to write a letter to the IRS and ask them to remove some of your penalties. So the IRS has a one-time or first-time abatement penalty relief program. There are likely some asterisks or nuances on who qualifies. I think one of them is, all your tax returns must be filed, but you may be able to request penalty abatement, meaning you'll still owe your tax bill, but you may get some relief on some of the additional fees and penalties that were added on. If you get notices from the IRS or a state, respond timely. Don't put them in a bucket and forget about it. If you respond And you can maybe at the same time ask for penalty relief or respond and attach the forms for the installment agreement. You just don't want to ignore these IRS notices. So act quickly if you've got a CPA friend, if you've got ChatGPT, if you've got somebody who's just well versed with working with the IRS, ask them for some insights, but respond to those notices. Do not ignore them. And then if you missed an extended deadline for the IRS, you likely missed it for your state as well. Most of the state returns piggyback or follow the federal IRS return. So you will need to make sure that you're compliant for both the IRS and your state. And it's a short presentation today. That's it. That's all I've got. And we've got one question in the Q&A. So we're going to turn it over to, before I pivot, we've got a quick poll. And I know this was a short session and we've got a small group. So we're going to pause here. Is this information valuable? Is it useful? Is it applicable for the time of year? We are testing out new webinar subjects. And so your feedback is helpful. Maybe we can put back some of the other subjects that we do more frequently. Maybe this isn't the right time for this webinar. So we do appreciate your feedback. And we'll leave this up for a quick second. And before I turn it over to Q&A, I'm actually just going to stall to see if there's a little bit more time to get questions in. They don't have to be related to extension season. If you are somebody who found collective because you're exploring LLC versus S Corp, or you don't know what's deductible for your industry, we can use this time for live Q&A, all things freelancer, all things solopreneur. I welcome these questions, so feel free to put your questions in the Q&A. I'm going to hang out on this screen here. If you are interested in talking to somebody on our team about whether or not collective or S Corp is the right solution for you, you can scan this QR code and write down this promo code fall1 or fall50. It's a month at 50% off. What does Collective do? Collective is an all-in-one platform to support solopreneurs, freelancers in operating their business under the S Corp tax status. And so in short, the S Corp, what it lets you do, what it may let you do is control and reduce how much you pay in self-employment tax. So if you're somebody who's set up as a sole proprietor, maybe you're a single member LLC, and you're interested in figuring out a way to reduce your tax bill, the S Corp tax status could be a good opportunity for you. What Collective does is we can form an LLC for you. If you have one already, we will prepare the S Corp election paperwork for you. And then we help with everything you need to maintain that S Corp. So you need monthly bookkeeping, you need payroll to pay yourself a reasonable salary, you need to file a separate business tax return. And so that's all the stuff that Collective would bundle for you. So if that's something that sounds like you need or you want to explore, if you need it, feel free to scan this code. We've got some good questions in. The stalling worked. Thank you, Katie. Thank you, Ken. I'm going to take a look at the Q&A box. There's 5 questions. We got 7 questions. So I'm going to stop sharing my screen and we're going to switch gears to the Q&A. So Katie, or no, let's see, Tanya, I'm sorry, I missed your question here in the chat. Tanya, if I apply for a payment plan with the IRS, could it possibly negatively impact my business for other things, such as business opportunities, my personal income tax, applying for loans or financing? That's a great question. I don't know for certain, but most likely no. I don't believe that your personal tax obligation, when you create an LLC, let's assume that your business is separate legally. So you're not a sole proprietorship. In the eyes of the IRS, your business has its own tax ID. It's separated from a liability perspective. Applying for an installment plan is typically done at the individual level. So it's a different tax ID and tax profile. Most often than not, that separation is enough to not impact the other. But things like maybe your business history, how long have you been in business? Maybe there could be some personal backing that the IRS would rely on. In terms of business opportunities, your installment plan is not public. So like you don't go and tell potential clients like I'm on an installment plan with the IRS. So there's no way for them to know it. It's not public information. Um, so Tanya, in terms of your personal income tax, you do have to make sure that all your past due returns are filed in order for the IRS to accept that installment plan. Um, Failure to maintain the schedule or missing payments could have an impact to penalties and interest. Um, Applying for loans, there could potentially be something with your credit if an installment plan is defaulted. But in terms of other business opportunities and seeking clients, it's not public information. Katie's asking, I found you since I need some information about coming out of SS into Corp to protect assets, and this is confusing. Katie, I invite you to send us an email after so we can get some more information. It sounds like maybe there's some nuance or something specific here, but coming out of Social Security into a business or self-employment, I may need some more context, Katie, but we would love to talk to you about this question. Ken is asking, choosing between LLC versus S Corp for a renewable firm, thoughts on reducing tax bill for this industry, renewable energy industry, particularly solar and energy storage. So Ken, what you're describing is, it's beyond the scope of Collective. We're mostly here to support service-based business. So like maybe if you're on the consulting side of the renewable energy. Typically what I've seen in my time in public accounting is these types of businesses can structure in either LLC versus S Corp. It depends on who's owning it. If it's going to be one owner, single member LLC, you would have to proactively elect S Corp status to, put everything on a separate business tax return. If it's a self-employed activity, Ken, then the S Corp could potentially help reduce the tax bill. There's often a lot of tax credits or R&D studies that go with that particular industry. And so what might be more valuable is a more traditional accounting firm that's got a separate leg for, credits and case studies for solar. So there's a lot of tax advantages for renewable energy. It just may require more costs, more expertise for the industry. But LLC versus S Corp depends on who owns it. If it's a self-employed activity with just you, generally over 60,000 of profit. There's usually a lot of startup costs. Some of these credits can reduce your taxable income substantially. So it's worth a conversation with a CPA, but tax credits are going to be a big part of that business potentially. I would like to hear more. In what circumstances is it not advisable to have an S Corp? I did my own S Corp taxes this year and thought it was all unnecessary with my small business. Is the pain worth the benefit? Ritu, that's a great question. Every situation is different. So most people will start to explore S Corp when they want to see a reduction in their self-employment tax. And so usually people will decide to switch or they make that decision when the savings potential is more than what it costs them to do the extra work, whether that's fees to different parties or your time. And so in your instance, Ritu, like it sounds like you're DIYing it, which comes with, paying for a bookkeeping subscription and then doing your own books, figuring out the payroll component with a payroll software, and then self-preparing a business tax return, which is a lot of work. It's also the reason why Collective exists. We bundle that all together under one platform, one subscription to help manage S Corps. Is it worth it? You want to consider maybe what your savings are. In the instance that you've got maybe a high earning salaried role and your S Corp isn't earning that much, maybe it's less than 60,000 of profit, you may be spending more time, more effort, more money on all your compliance work, bookkeeping, payroll, tax filing, than any savings advantage. And so it may be worth, doing some quick math to see, is the savings potential there? If savings is a motivator for you. Now, there could be an instance where maybe you are looking for an investment property or a mortgage and you need proof of income that's not on your personal tax return. This is a common reason people opt for S Corp also, is it requires that they put themselves on W-2. And so if your motivator is not the savings, but maybe it's proof of income, maybe it's business financials and a separate business tax return for future grants or growth opportunities, those could be separate advantages for maintaining your S Corp regardless of savings potential. So Ritu, I think if you're DIYing it, I will just validate you and say it is a lot of work. There are solutions like Collective who may be a good fit to take some of that off your plate, and then maybe it'll just kind of let you go back to doing your thing and running your business. It's a great question. Anonymous attendee, is the interest paid twice, one for the S Corp and one for the individual? It depends. So I'll level with you. I'm a little rusty on how the K-1 penalties work. I'm not sure that there's interest accrued on those informational returns. It sounds like a 220 flat failure to file per shareholder. So interest is typically accrued on unpaid tax, where the fees are assessed on K-1s for unfiled or undelivered K-1s or incorrect K-1s for the S Corp level. Mallory's asking, what is a K-1? That's a great question. So if you're a business owner and you've got an S Corp or a partnership, a pass-through business means that the business itself does not pay tax, but rather the owners do. And so when you file an S Corp tax return or a partnership tax return, any pass-through business is going to have this form attached called a Schedule K-1. And a K-1 is generated for each of the owners or each of the shareholders of the business. And it shows their percentage of business profit, distributions, charitable contributions, so that that owner can include that K-1 in their personal tax return. So similar to if you have, like a salaried role from a corporate job and you get a W-2, you would also include a K-1 in your personal return. So it's a tax form that comes out of a pass-through business issued to the owners so they can report their share of the business income. That is a great question. Thank you, Mallory. Marilyn is asking, considering filing at a later time generally involves gathering old documents, receipts that you may not have properly tracked. What would you recommend are absolute document inclusions? So it depends on what type of return you're filing. If you have a business tax return, that business tax return is ultimately reporting your clean and correct financial statements, profit and loss, and balance sheet. If you're an S Corp owner, you also have a requirement to pay yourself a reasonable salary. So you may need to include single member LLC and personal, Maryland. So for S Corp, you'd also need financial statements, maybe your salary, the W-2, and that's used to populate the business tax return. So that's absolutely necessary on the business side. For a single member LLC, you report that business activity on Schedule C, and it's essentially a profit and loss statement. And so, whether or not you had like an accounting software in place, it could be as simple as an Excel spreadsheet that totals your total revenue, what you billed from your clients, and then your expenses by category, office expense, membership, marketing. And so a spreadsheet would be sufficient if you made any large purchases that kind of look out of place for the nature of your business. Maybe you bought a new laptop and that's not something that's typically recurring. Keep that receipt in a file on your desktop. You don't necessarily need to gather all the receipts when you're putting together your, spreadsheet. But if there's anything that could look out of place, you want to be able to substantiate that. So for a single member LLC reporting on Schedule C, an Excel spreadsheet of your profit and loss for the year is what you need to populate Schedule C. And then if you got anything else on your personal tax profile, Robinhood, stocks, your spouse's W-2, the rental activity. But I hope that answers your question. It can be as simple as an Excel spreadsheet. Receipts, you don't necessarily need to gather all of them, but keep them in a file for big purchases. Tanya's asking, who issues the K-1 to us S Corp shareholders, our bookkeeper? Whoever prepares your business tax return, because the K-1s are included in that entire tax package. And so if it's a CPA or you self-prepare a business tax return, that deliverable will also include the K1s. So if you've got a CPA doing your business tax return, the K1 will be in there as well. Would you advise to file tax returns on time, even if they are not correct, and then take some time to amend the return? Ooh, that is a good question. So I come from public accounting and I've seen things done, the way you need to do it when push comes to shove. I will just say right now, you always want to file an accurate return to the best of your ability. In practice, submitting something that's, the best of your ability just to meet a deadline, I've seen that happen with the intention of amending promptly. It's more costly. It costs you more money potentially to pay for an amended tax return. It depends on if you're doing it yourself or you're paying a CPA. I've seen, the kind of the reality of the accounting industry. Sometimes this needs to happen. So maybe it depends on whether or not you have tax due. And maybe if you have an unpaid balance, it's going to start the clock on penalties and interest. But I have seen it done where people file to make a deadline knowing they're going to amend. I'm not saying that's right or wrong, but I have seen it done. So it could be an option. Consult with your CPA, but it has been done and the IRS does allow amended returns. Catherine, I've lived in Connecticut for 7 months and California for a little less than a year. I have my mail going to Connecticut and have a car registered in Connecticut and a driver's license there. Only stayed in an Airbnb in California. Do I owe tax in California? So Catherine's asking a question about establishing residency, like a tax presence between states. Technically, if you spend more than 6 months in one state in the year, it could constitute a tax presence where you're a part-year resident. It may not matter where you stayed, but it's more about, more than 6 months in a day or not. Maybe it also depends on if that was a true move or it was travel. But I would say if you were in California for more than 6 months, it could be worth some further consideration. Last question. Thank you so much for the participation. It was a little quiet in here and we've got some great questions out of this group, so really appreciate it. I received a late S Corp election for 2024 and didn't issue myself a reasonable salary for 2024. Is all my 2024 net profit considered ordinary income? So first we'll acknowledge the late election. You should have received a confirmation from the IRS confirming your S Corp effective date. So as long as they approved it for 2024, the best practice is to pay yourself a reasonable salary. If they approved it, in some instances, the IRS is lenient on the first year of being an S Corp and the reasonable salary. The trigger, if you took distributions in 2024 and no salary, just as a heads up, it could be a red flag for the IRS, where they may say for this 2024 period, you took distributions of 60,000, but not a reasonable salary. In their perspective, it looks like you avoided Social Security and Medicare tax because you still took money out of the business. So just as a blanket statement, maybe anticipate a notice. If you get something, I just don't want you to be caught off guard. If you haven't already, get payroll established for 2025, potentially do some catch up. But the high level question is my 2024 net profit considered ordinary income? Yes, your business income out of an S Corp generally, assuming it's, service based, it's not investment, it's not rental properties, it would be considered ordinary income. We got a couple more questions, Tanya. How long after the October 15th deadline does the IRS allow one to file an amended return once you file? I forget what the statute is for filing an amended return. It may be 5 years. I'm sorry, 7 years. I'm not. Thank you, Daria. 3 years. 3 years to get caught up. I'm gonna do some more research. So thank you, Daria, for weighing in on that. 3 years to file. Filing as soon as possible after that deadline, though, will stop penalties and interest if you owe. Jonathan is asking, can you give the number for contact at Collective? Jonathan, let us, Daria, thank you so much. And I thank you for being here when you're so close to October 15th. You probably have a backlog of tax returns to start reviewing or preparing. Jonathan, we will get you the information so that you can get in contact with Collective and schedule a call. Thank you, everybody, for the participation. We are going to have one more poll at the end. We want to make these sessions as valuable as possible. Your feedback, weighing in, the questions are all great questions. So thank you for joining. These are free every Wednesday. You will get a recording of this session, and they're also posted on YouTube. We'll see you next time.